Hi, it is June 16, 2023, and you're watching me, Nikki Yu, also known as Awesome10X, for this global market update this Friday, June 16, 2023. Let's begin. I'm going to try to show you scooping up proven companies at bargain prices in an elevated market. Let's discuss a few companies that I'm looking at in the buying list. There are actually some names that are actually getting rotation. We noticed that move since June 2023 from elevated mega caps towards actually some bottom fishing valuations that are not necessarily trading at 100 times PE or 200 times AI names. So let's take a look at these names today. Let's take a look at them one by one. Okay, let's talk about it. Wait. Okay, let me see if this works. Hmm. Wait up. Let me just modify that again. Cinema layout. Yeah, I guess let's do it this way. The usual. All right. Okay, so today's topic, let's scoop up some proven companies at bargain prices. Are there some companies that are still at bargain prices in an elevated US market? And the answer, I believe, is that there are actually companies that you could buy, not just the small caps at 80 to 90%, which I tweeted on Faces Trader on my Twitter account, but some names that you will actually learn about, okay, or already familiar. So, a few things. I do believe that if you're going to try to find some bargains, it's obvious that these companies are not necessarily beating their quarterly results, and there's actually some caution on what they are reporting. So you can see that Home Depot actually lowered their full year forecast, Macy's lowered their full year forecast, Target held guidance, and Walmart was one of the only companies, aside from I think Costco, who raised their full year forecast in their retail sales. You've got on the headlines cautious consumers hitting retail guidance. So within the retail sector, a lot of people have been shorting this sector, and there is actually some signs of support. Whether that is a squeeze or actually a sustainable run, let's discuss about them today. We've got some videos to also share in case you want to listen more. Inflation, retail sales data show people are actually paying more for less, says strategists. You'll see that in this Yahoo Finance video, which was just released about 8 to 10 hours ago. Find it in Yahoo Finance with this headline. The U.S. retail sales so far is still rising at about $700 billion. And what you should actually pay attention is actually that construction building materials actually is rising in the retail sales format, meaning there is actually strength in home builders and construction materials. We'll discuss how we can make money on that. But basically, if you are building a house, that means that at some point in time, Home Depot lowering those forecasts, and actually Low Company is actually likely to be trading at lows, and we're actually going to have some valuation movement on those two companies aside from the paint materials like Sherwin Williams. Let's take a look at some news or some well-known things that we already know about. In the US, you actually spend most of your money at some point either in Costco, Walmart, Amazon, Home Depot, Lowe's, Walgreens, Boots, Kroger, Target, CVS, or Couche-Tard. In this case, we're going to be focusing on some of companies that are actually trading at 25 to 35% discount, such as Home Depot, Target, and Lowe's. So actually, we're going to focus on those, but we will still actually discuss a little bit on the rest. So people we can see today in America are actually selectively spending. And if you take a look at the top 100 companies, of course, the market share is not much changing. But the point is that if you take a look at Home Depot is still one of the top five with 4.37% market share. You've got actually companies like Walgreens Boots with a 3.67% market share, Target with 3% market share, and Lowe's companies at about 2.7% market share. So you actually even have Nike trading at the number 13th with about 1.41% market share in retail market, which actually proves something of a strength in execution for Nike, considering the rest of the companies here in terms of retail sales are actually more of a one-stop shop rather than just selling leisure or athleisure wear. You'll notice as well in many headlines, and I want you to focus on the bad news, that when you are buying companies, you're actually looking at very negative news so that you can see and find the dark clouds as your signal points to understand why people have been selling them off. So for Target, there's actually a lot of a profit loss forecast due to the organized crime or what they call retail theft warning. $500 million more is being lost in a Target more than last year, said by Target CEO Brian Cornell. We continue to contend with significant headwinds caused by inventory shrink. This problem has been affecting all of us, limiting product availability, creating a less convenient shopping experience, and putting our team and guests in harm's way. We've seen this happen not just in Target, but in other retail stores. And it's actually really affecting their profitability. You'll notice as well that the rise in crime can actually be another hint of consumers actually getting really difficulty with inflation. And you've got actually other companies seeing the same results, especially low income families like Dollar General. It actually fell 10% after their earnings season, after earnings miss, slashing their guidance for the full year 2023. You've got data on credit card debt in the US hitting $1 trillion mark. And you've got actually on the violet line here, violet and blue, 20s, 30s, and 40s actually have the highest delinquency in terms of age group. With more they have the higher risks, right? And then only just less than a percent for the 50-year-olds and above. So we're actually seeing that there might be more delinquency rates that could affect retail spending. And these bad news is, of course, something for buyers to actually look at. One, because you might be buying too early, and another, because if you really are looking for bargains, bargains can be found in bad news, not when you're seeing all the entire market talking about, oh, the economy of US is great, the retail sector is doing well, etc., etc. What we're actually looking at here is, okay, find the bad news in an actually successful company in a top 10 or top 15 or top 20 company in the retail space, and see whether that bad news is going to end within 6 months, 12 months, or more than a year. So you've got actually struggles in retailers in a downturn. Retail City's Brian Gildenberg. This is another video that you want to check out. Health of the economy, outlook from retailers. You could see that Dollar General is struggling. It shows you that the economy in the US is in a downturn. And this is one of the reasons why there are quite a lot of bears in the retail sector. And that's one of the reasons, not just about the woke movement saying a boycott on Target, but I think in general, it's about really the consumer spending. So they're saying here, beyond a spending slowdown, they're getting impacted by SNAP benefits reset. Malls are replacing department stores with consumers. Retails are had more to do with inflation, lack of promotions. So you've got actually a lot of headwinds here in the economy from retailers, and we'll actually see more transcripts. Let me share to you more. Now, you'll notice that in 2019, there are actually the explosive rise of dollar stores. You've got companies like Dollar General, Dollar Tree, Family Dollar. These are actually companies that are all within the same. So Dollar General and Family Dollar is actually owned by the same group. And then you've got Dollar Tree. So you've got also Aldi and Five Below. These companies or the dollar stores were actually a hit in America for selling low price goods. And it's definitely something that you would look at as a discount retailer in a recessionary environment. So one thing that really should strike you is that no matter if the consumers in US are actually selectively spending, you do have to acknowledge the fact that there are still at least $2.4 trillion in terms of sales in the entire USA, which means that the top 10 retailers are not actually losing money as much as their share prices or as much as the headlines would actually note. Now, there are, let me share to you a few things later. Yeah, that would be Chinese cars. I'll talk about that later. and some Chinese companies like JD Retail. Yeah, but as you can see, discount retailers as a whole, as an industry, are still continuing to find ways to thrive. Top 10 alone has been totaling $2.4 trillion in sales. In terms of Dollar General, they do say that regarding value, they feel very good about their price position relative to competition because they have the prices that consumers can afford. Believe that Dollar General more than ever has more than 19,000 stores located within 5 miles of approximately 75% of US population, uniquely positioned to provide customers with access to everyday household essentials, particularly in rural America. Now, across multiple fronts in Q1 2023, supply chain recovery efforts ended the quarter with our best distribution center service levels in nearly 2 years. And while we are pleased with the progress, we are still focusing more strategically serving our customers. Let me provide details on our Q1 results. Same store sales still grew 4% in the consumables category. However, this was partially offset by a decline of 8.5% in the non consumable category. So you're seeing food groups versus non food groups continuing to shift more of their spending away from discretionary goods. This is actually evident in most of the retail sector. We're seeing that softer than expected sales in the quarter, primarily driven by deterioration in the macro, headwinds from lower tax refunds, reductions in SNAP benefits, and possibly unfavorable weather during the months of March and April. For Kroger, let's read further from their transcripts in the earnings call recently. Same thing. Customers are spending more on food, and our value proposition is resonating. We've got great value, driving strategic incentives, sustaining our momentum. Customers still look for ways to save. We're providing a fresh and affordable shopping experience, zero compromise on quality, selection, or convenience. And our value proposition is something that every customer will lead to increased frequency on customer trips. And this has still been our eighth consecutive quarter of household growth. You'll also see that during this quarter, Q1 2023, we are delivering more savings, including working with our suppliers to fund more promotions. We have gone through increase approximately 380 basis points, and digital coupon redemptions increased 180 million. Now, the other thing that you would see is that the economic environment is more significantly impacting our budget conscious shoppers. Mainstream and higher income shoppers are increasing their spend with us and deepening their loyalty. We grew our mainstream households, making up the largest segment of our customer base. And we are seeing growth in higher income customer households as they're migrating from specialty retailers towards Kroger, building larger baskets and spending more per item. I think this was also echoed by Walmart in their earnings results, wherein they've gotten market share actually from people who used to spend also in high end or specialty retailers towards Walmart. Okay, so you can see as well that Dollar Tree has conquered low income America. While there are actually a lot of retailers, I'd like to start off with a few things in my mind or my shopping list. My shopping list includes Target. And then I've got some shopping lists on the construction building materials in the retail segment of home improvement, specifically Home Depot, Low Companies, and Sherwin-Williams for paint. I'm also taking a look at the retail sector, which is, while there is actually a lot of discretionary spending that is lowered in this time and in place, of course, in USA because of the inflation impacts. Nike is, of course, getting hit with that. I do believe that most of these inflation, if peaking within a year or so, is going to actually probably make a bright turn for retail, not necessarily in this quarter, which you saw in those bad headlines that I read to you, and those lower guidance for full year 2023. But as you can see, looking in the stock market has nothing to do with 2023, but looking actually towards 2024, 2025, whether you see those credit card delinquency rates actually increasing, leading to more sell-offs on retailers, or whether they are actually priced in. Now we want to actually take a look on some Chinese plays like Nike, Starbucks as well. Take note that Nike and Starbucks is a global brand, so it doesn't actually relate simply to the US consumer, but also to the Chinese consumer. Now we've got also some looks on Domino's Pizza, as well as, and of course, Disney. So these are actually some of the companies in the US market that haven't actually had a very great earnings report. And yet we're actually looking at these bad earnings to see on whether do we take a contrarian long position on them. For Home Depot, one thing that really stands out is that it is a one-stop shop. It is a warehouse model. It's got really low prices, lots of locations, and of course, customer service. So one thing that I wanted you to also see with Home Depot is actually if you look at all the earnings results of home builders, whether you're looking at KB Homes, Lennar, Pult Group, all of these building materials in US, you could see that they basically are seeing stability in housing prices and they're actually seeing growth in their home builders. There's actually some specific demand in the US housing market, specifically on building. We emphasized actually with our Awesome10X members that one of the reasons that we changed our view about the home builders or the mortgage rates about 7% and 30-year mortgage rates impacting affordability is that in reality, while the houses in the secondary market are very expensive, a lot of the home builders continue to actually thrive. And people are actually building houses because one of the reasons is they do have land. That's one of the reasons why Lennar continues to have racing orders, deliveries outlook are still being raised. You actually look at the entire video if you could. This came from Bloomberg. There is a real supply shortage in housing. And you can see that most of the houses, when you build it, as long as you do have land, if you already bought land, say 30 years ago or 20 years ago, and so on, you can actually build your house for like half of the price or less than about $400,000 per house building it rather than buying it out in the market where average prices are trading at about 600, 700,000, 800, a million, and so on. So there's actually a lot of demand back to the housing market. One of the reasons also is the age of inventory. So there's actually a lot of houses in the US that are really aged 30, 40, 50 years old. That means that they were built since 1980s, 1990s, or even some are even less than 1980s, so not even 1960s. So there's really a lot of parents and boomers who have wealth. You've seen that perhaps in the earnings results of the cruise liners like NCLH, Norwegian Cruise Liners, Carnival Cruise Liners, that the boomers are actually helping the younger millennials. So the 50s to 70s actually are still wealthy and they're able to help their children actually build houses and pay for those building materials in cash despite very high interest rates, which is why cheap lumber prices, despite rising labor costs, are still hinting further demand to the US housing market, specifically on the home building sector. So it's actually cheaper to build rather than to buy. And may I just say that although it's happening in US, I would say that it's also happening in the Philippines, where construction sector continues to dominate, which is why if you think about it from a longer term standpoint, this means that you want to actually locate hardware stores in the US. That would be Home Depot. That would be the likes of low companies, home improvement sectors where you can buy lumber, where you can buy a lot of these cement, etc. All of these hardwares are still actually significantly earning money, and there's actually enough reason to buy them while they are cheap. Okay, so the supply shortage in housing is really one of the primary demand drivers here for the reason why people continue to build houses. And you'll notice that housing builder ETF is actually trading near all-time highs, if not at all-time high. Let me show that to you. XHB here. We'll go through the charts furthermore, but you can see that XHB is actually in a pattern where it's just continuing to rise further. And it's actually been strong simply because the entire home builders ETF is actually getting a lot of demand from the US, Americans building houses essentially. Okay, let's go furthermore. So when we talk about the biggest retailers in America, yes, you've got Walmart, Target, Home Depot, Kroger, Costco, Lowe's Companies, Best Buy, Costco Wholesale, which is part of Costco, Aldi. Amongst this, I do want to share to you that as of recent, while there's a lot of bad news in the sector, take note that these are interesting companies that are actually down 50% from the peak, trading today at about 12 times multiple. And one thing that is really taking my eye on Target, aside from the fact that it is a company that has existed since 1962, this means that this is one of those companies that is more than 60 years old already. You got actually enough reasons to see that from a long-term data, it's unlikely for somebody to actually just see Target suddenly go offline or suddenly just drop without anyone trying to buy it, saying that it is irrelevant as a company and so on. So this might actually be one of those bad news while at the height of the boycott data on woke movement about the Pride Month. This actually stands out in my view, one of those companies that you want to dig deeper and read further in your buying list. So actually Target is one of those important buys, not just the fact that it's actually been bottoming out here at 125 to $130 as well. So I'm actually willing to buy this at 139, 136, 132. I've been buying it already, but I continue to buy further because I could see that this can easily go back to $180. Not necessarily, of course, within the next 5 days or so, but maybe in about 6 to 12 months. So there's actually enough reasons for a company that is trading at 0.6 times price to sales. So there's actually a valuation gap here, which is why we're actually looking at Target, so that's why it's worth investigating upon. I'm going to talk about Home Depot and Lowe's later on, but basically you can see from the chart targets there. Domino's Pizza is also another interesting company in my view for us to watch out for. Honestly speaking, Domino's Pizza was being sold off because of again the consumer spending affecting the inflation. It's one of those companies that had been lowering their guidance as well, but it is highly possible that all those lowering of guidance could be actually those weakest earnings could be the worst already being priced in. So there's actually enough. Last night, there was already an upgrade on Domino's Pizza, seeing that this company is not necessarily going to default anytime soon, nor will the consumers actually suddenly stop eating from Domino's Pizza. So you actually want to watch for these, I would say, proven companies that are already successful business models and actually watch on them, given that they've already dropped 50% from their peaks. Domino's Pizza from about 600 areas to about 300 areas. This one is something for us to actually investigate more upon. So I'm actually showing to you companies that I'm looking at on the buy side, buy list. Sometimes I buy a little and then I validate it further with price action. But also the fundamentals, I believe, is still intact with the fact that Domino's Pizza has dominated most of America in terms of casual pizza restaurants. So this is actually something for us to look at. Okay, and of course, the takeout delivery is still very, very good for Domino's Pizza. As I did say, Sherwin-Williams is part of that list when I like to look at home building materials because it's impossible to build a house without actually paint jobs. So Sherwin-Williams, after dropping to about 45%, more so because this is a company that is a dividend aristocrat, which means that it is paying dividends since more than 25 years. So these are actually some great companies in my view that has been dropping 45, 50% or so. We're actually, in my view, on the cusp to remain long-term uptrend. You'll see that if you look at the all-time moves of these companies, there's a specific criteria. One of the reasons why I want to showcase not just the charts for you, although the charts will already tell you if you're looking at the long-term chart that Sherwin-Williams, Domino's Pizza, Target are those companies that in effect rebound. It just give them time and a few years. Same thing if you take a look at Nike here, which I'm going to put in the retail buy sector. You'll notice that here at about 102 to about 113 with with a likelihood of even if people are actually selectively spending we do note that the uptrend for companies like Nike would still execute well on the long term. And therefore, these entry points after dropping from 180 towards 80, rallying towards 120, and then back towards 100 is actually your entry point to buy the companies that are executing on a worldwide scale. So you want to actually be watching on these themes. Okay. So we've actually been yeah. So well, in the first place, I would always want to acknowledge that if I'm gonna buy something, I want it to have a proven record, and most of these companies already are existing, sometimes more than 50 years already, which is one of the reasons why there's more reasons why these blue chips will definitely recover. And if they have some problems, well, where actually Nike was already fixing their inventory problems since the first quarter 2023, we actually saw the transcripts, and one of the reasons that really catalyzed Nike to go back up is because China's stimulus rate cuts. Now, you might argue that those retailers would have bumpy roads ahead. So, we're not saying that this will be V shaped recoveries, but it's actually companies that are in this global nature that rarely actually comes at a very, very huge discount. I would say that these companies are considered GARP, which is great, attractive value at a fair price. So, reasonable price. Shopify is also one of those e-commerce companies. Despite the fact that I understand we're talking about retail stores, I do believe that e-commerce has had a very strong effect in the US. Of course, Amazon and Shopify are both in your retail. It's just that Shopify's gross merchandise value is not written in the retail, but in the e-commerce section. So either way, we're seeing actually the Shopify. Let's actually watch just simple Google. You can just search it. Shopify gross merchandise value for you to assess the billions of dollars that it already is processing. It's nearly about $47 billion, 60 bill. Okay, last reported quarter in Q1 was $50 billion. This is still up 15% year over year. In 2021, it was 175. In 2022, it's 197. So in 2023, we could probably be looking at about $200 billion as well. This is sales volume across all merchant stores. And I would say that these, when I look at retail, I do look at sales revenues, and it's very important that if you are in the top 10, you will actually be in the function of my important buy lists. Simply because where people spend their money, it means that it will not disappear anytime soon. I would definitely see that among the growth names that are actually quite valuable here, whether you want to talk about their price to sales, the lack of earnings, etc. Actually, Shopify might improve going further. That's one of the reasons why it broke out from 40s to about 50s to 60s, even with the sale of Flexport, their logistics arm, is because obviously they can go back to having high margins again as a software company, enabling many retail merchants to sell their stuff online. And I do believe that in America, the penetration rate in US online sales continues to dominate just as much as Walmart, Amazon, and all those retail stores have definitely gone on board with shopping online. So all of them, like Target, they all have very strong sales in their e-commerce front. Just to give you a notion of how strong the sales of Target, even in 2021, 2022 levels, you'll see that they have about $100 billion in when it comes to revenue, and their sales actually in the digital have been growing about 25, $27 billion. The traffic has been growing. They've been shipping this. They also have their own brands. Target has their own brands, $30 billion and so on. And they've got in the past about double digit comparable sales across food, apparel, essentials, beauty, home, hardline. So definitely right now, you don't see that strength in apparel, but you would eventually see that, making that case that Target will actually recover if you're looking at the American consumer sometime within the next 1 year or 2 years. If the market already is assuming a soft landing here, then these retail stocks will eventually actually recover after those bad news. Revenue of Target has been in a strong uptrend over the last 16, 17 years. And you can see that it went from billions of 50 billion to about 110. And I would say that for a company today that is just trading at about $60 billion market cap, it stands to reason that at 12 times multiple, you're actually buying Target at the low end here, and is actually good from a price to sales perspective or a PE ratio perspective to really watch Target whether it drops further or you just start accumulating already. And as I said, e-commerce sales continues to grow, and you're seeing actually that Target's retail sales in the e-commerce division is actually more than $25 billion already, something that has been growing over time and which I actually assume to continue growth, which will of course help in their margins as well. So we're actually very bullish, not so bullish, but I would say that I would be a contrarian even in the likes of companies like China. Let me share to you also a few of my contrarian longs. So I have been starting to buy in my small caps electric vehicles these great names like NIO and Xpeng. Obviously, NIO has been plagued by the fact that they've been losing a lot of money this year. And they have recently been sharing that they have some models, new models, and new deliveries that could excite the market. So Xpeng actually released 25,000 orders. That was one of the reasons why Xpeng is an electric vehicle has been growing. So these are the newer sectors, the newer electric vehicle sector. You'll notice that for a while now, these companies have been falling, and there's like no lack of bad news when it comes to China. But we would argue that after falling 90%, peaking here in 2021 for Xpeng, we're actually seeing a lot of reignition for this to actually even break out. So you'll notice that while Shopify has already been in an advanced stage model, even from a technical perspective, Xpeng is just actually trading the first stage. So usually the first stage, you do have some bumpy ride. The reason being, in the first stage, you're still actually buying a company that has not made money, is still unprofitable, but is actually trying to recover. The moment this actually breaks that level of about $13, then it can proceed further towards 24. So one of the catalysts, of course, of Xpeng in recent days has been the very strong sales outlook for their G6. Let me just show to you that one. The exact news for that. XPEV sales pre-delivery, 25,000. It was just recent here. The G6 in China is an all-electric pre-sale. Many visitors experienced a lot of show cars in Xpeng over the last 3 days, demonstrating their enthusiasm for the G6. Take note that we are bullish in America EV, we're bullish in European sales of EV, and obviously we're bullish in China's EV. That would be your mega trend. So you want to actually watch for companies that are in the $10 billion zone, $15 billion zone with proven expertise in manufacturing and proven ability to have that enough cash to handle any cash burns while they are still relatively just delivering 10,000 deliveries a month, 100,000 cars a year, not in the realm of Tesla's 2 million cars a year. You'll notice that this is, of course, still early. It's not the BYDs of the world that can basically already manufacture millions and deliver millions of cars. But that doesn't mean that these companies will fail, because these companies, number one, are subsidized. They were able to get their IPO funding to last them for at least 2 to 3 years. And they can act, and you might argue, well, what happens after 2 to 3 years? It all depends on their execution. It all depends on whether people will actually buy the cars that they manufacture. But I would say that there are lots of reasons to be enthusiastic about these companies with their growth ahead, despite being a small cap today. So Xpeng, one of those plays, of course, the EV maker. One of the things I really did like is because a lot of Chinese did buy this G6. And then, of course, if you look at the other car maker, which is NIO, they have been slashing prices over the last couple of days. And you'll see that in May 24, one of their launched SUV is the ES6, which costs for about $50,000. It has a 150 kilowatt hour semi-solid battery version available in July. You'll see that William Lee said that ES6 is a very well received by the users and had received very good feedback in the media. We think the order performance will reach over the expectations, and the test drive conversion rate of ES6 actually reached record high history in NEO. We're actually confident in terms of sales performance of ES6. At this stage in June, we need to focus on the ramp up of the ES6 first. This is actually closer to the Model Y in terms of like competition for those who are asking NEO's ES6 versus say Tesla's. We want to achieve 10,000 units in terms of production and delivery. In terms of ET5, which is the ET5 Touring, we believe there's also opportunity for us to still achieve 20,000 units in a month. The big challenge for us about the ET5 is that if you look at ET5's pricing, last year we still had around 12,000 yuan subsidies for users, and users can get home chargers for free last year. However, this year they need to pay for the home chargers. So that means that if they're gonna buy ET5, net speaking, they're gonna have to be spending 20,000 yuan more this year. So they still are trying to find ways to meet the user needs and demands. And they're launching the ET5 Touring on June 15. So they actually shared this in their NEO investor relations. NEO just launched the ET5 Touring, the first smart electric tourer. NEO launched this with families in mind. Let me share that one of the things that Li Auto did very well was the families. They did family cars. So this is actually one of those electric vehicles that NEO has realized that is trying to target a niche. In this case, families, vans, practical, better than a sedan, world's first premium smart electric tourer. So this is like if you are a fan of SUVs, electric SUVs, NEO is quite confident in this ET5 and in the NEO ES6. So this is how it looks. I am actually a little bit bullish on these two specific models to hopefully ignite buyer demand over the next couple of days or over the next couple of months. And I would say that the bad news for most electric vehicles is that they are assumed not to sell because of the presence of Tesla and BYD, and these small startup communities like Neo Xpeng is probably too late in the game to even make money. I would say that that could be true or that could be false. So it's all about the pre-sales, it's all about the deliveries. And I would say that with stock prices on Neo and Xpeng trading at 90% below the peak, there's actually these types of bargains that I would say, even if you don't consider them blue chips or top 10 EVs right now, it may actually be in the top 20 EV makers when it comes to China's industry, despite all the competition. So I would say that another thing that you may actually be also wanting to look at is the fact that NEO is not just about cars. NEO has an engineering team. They do a lot of houses, power stations, power chargers, and NEO services. So I think like you do have to watch some Chinese companies. Of course, China, I would agree with Michael Burry buying a lot of JD and Alibaba. I believe that Michael Burry has at least 20% of his portfolio today in JD and Alibaba, the Chinese retail e-commerce. Today, I just wanted to say that I believe in investing in where people spend their money. So let's say for every typical household, they'll have to spend on food, groceries, etc. This also underlines my reason why, even in the Philippines, I do believe that while there is an SM trading at a premium, it is still actually very valid even for Filipinos to watch for some retail bargains in the Philippines, such as P Gold. Pure Gold is actually one of the purest, still the purest play when it comes to Philippine companies in the realm of retail. So retail stocks in the Philippines like Pure Gold is actually dropping here at 28. I do own Pure Gold. Disclosure, I do own Robinson's Retail. I was picking it up at 52.50, so I'm happy that it went up. So of course, when it comes to retail, there are companies like SM, but SM Investments in the Philippines is more on the premium zone. So it's more like Walmart already in terms of pricing, or Costco. So it's more in the top end. So there will always be those still strong leaders. It's not like number one, But pure gold is actually, I think, well, in terms of sales revenues, it's about 200 billion pesos. Of course, it's something that you want to be watching out for. So in the US, I would say Target is one of those undervalued plays. Let's take a look on the retail segment in the US. Let's take a look on these stock charts for them. So Target, 50% down from peak. You've got Kroger here, also down 30% from peak. So it's something actually already trading at about 2021 areas, supported at about 43. Even on a very weak number, you can see that people picked it up, buying 43 to 46. Let's take a look at some of their the dollar stores. Let's take a look at Dollar General. Despite the fact on the very, very bad drop here from 200 to 150, we are already seeing that some people are looking at the fact that, hey, what if these US consumers over time, all of those bad news is priced in? So what 280s, 260s down 40% here, starting to be picked up slowly. There could be a bumpy road ahead, so let's not actually predict that these stocks could go like all-time highs. But it's something for us to watch in terms of the sector and retail. And when it comes to retail, I would say that there's definitely the discretionary spending, there's definitely the not the consumables. So what really underlines the strongest ones is the consumer defensive on food and retail, food retail specifically. But I wouldn't actually say that that only food matters, because when you look at Amazon or when you look at Shopify, obviously when you consider 2.4 trillion dollars of sales for the top 10, you are actually considering everything that people spend money upon. Although it will not be very frequent for people to buy a shoe or a shirt, maybe they will for the Father's Day occasions, etc. The point is that they will still focus more on buying and spending that money in retail stores. So it's something for us to actually be always on the lookout for. So Dollar General there down 40% from peak. Dollar Tree here about also at support after that breakdown. I think that after the earnings, some people are looking already at these companies for some pickups on bargains. So Dollar Tree down 27% from 175 towards 128, bouncing a bit. You've got Target down 50%, as I said. Dollar Tree, Dollar General, Kroger, Home Depot. Let's take a look at Home Depot. Home Depot's down 30%, 35% from the peak here, 420 to about 270. For those looking for building materials, that means that in the Philippines, although I would say Home Depot might be cheaper than the Philippine counterpart, Wilcon Depot, but even if you actually started picking it up at 26, the next support at 21 is actually still there. I would say that I think like it's trading. I'm not sure if this is trading between 20 times multiple for Wilcon Depot, but it's all about the home building sector that you want to actually be looking at. As long as the residential homes are continuing to be built, as long as there's improvements in the home that is continuing to be built, simply because of the expensive condominiums and expensive housing prices already in the market, a lot of people are actually focused on building houses probably far away far away. Let's talk about suburban areas. That's where majority of the building is happening in the Philippines, is outside Manila. So the likes of Cavite, the likes of Bulacan, the likes of Pampanga. So those are actually positive tailwinds for companies like Wilcon Depot. Same thing actually happening in my view for Home Depot, which is why you want to actually be contrarian and looking at these data, that it's not all the same when it comes to retail. Yes, American consumers may be, spending less, but they're actually selective in what they're spending less. If it is essential, then definitely they would still have to spend for it. So if it's an essential product, like building a house for their family, that would still actually mean that there will still be actually a buyer and a recurring demand for the products there. So Home Depot here actually at $300 is something that I do expect to hit back towards 330 to 350 over the next 6 months. You've got a company as well, which is Lowe's companies, the competition with Home Depot, also trading now actually higher after dropping 35%, slowly picking up inch by inch over a year. from 170 towards 220. So you want to actually be looking at these levels, like Sherwin-Williams as well, diba? So these are companies that you want to be on the bargain hunting side, in my view, once when it comes to retail. For JD, so this one is more on China. So for China, I'm really more on the assumption that the Chinese consumers will number one, I really want to invest in where people spend money, as I said, whether it be Philippines, US, China. So when it comes to China, the majority e-commerce place is really Alibaba, but Alibaba is very big. You can see that Alibaba is spinning off some of their e-commerce. They're doing international IPO for Lazada. Somewhere in the 12 months, they talked about it, so that you've got Alibaba China, you've got Alibaba International, the spin-off for Lazada, the Tmall Express, and all their Trendyol. So they have actually a lot of e-commerce place inside Alibaba. Now it's very important that you want to actually look at JD. JD is the number two, and of course, one of the reasons why JD has been very, very strong in the Chinese market has been the distribution efforts. So JD has actually one of the largest logistics. So as Alibaba is spinning off their logistics company, Tainiao Express, you've got actually JD Retail, which already has logistics networks as well. Also, number two, when it comes to e-commerce revenues in China. So JD, I think also has some brands in Southeast Asia, but not as popular. So no need to actually discuss a lot about their international efforts yet. Although JD, I believe, is present in Thailand, if I recall. But you can actually take a look further on their transcripts. Either way, one of the things that I do want about JD, I've been picking it up since 36, 33, even at 40. I do believe that there's still some valuation gaps here. You can see that amongst retail, whereas in the US, you're seeing 35%, 50% drops. In China, it's actually even bigger. You've got the 70% discount in one of the largest, if not the second largest, e-commerce company with warehouse automation and very, very strong profitability over its business. So I would say JD.com is something to look at. It's now trading actually one of the lowest levels since 2014. Here at about 33, it started to recover at 40. I do believe that JD Retail has the market share and the profitability for you to actually want to get in. As I said, my purpose here is to give you just a shortcut analysis. But if you want to study JD further, we can do some deep dives on it. Just come to awesome10x.com. Really ask me for specific insights on these companies that I mentioned. But these ones have been part of my buying list actually ever since I studied China. So also one of the good things about Chinese funds is that most Chinese passive funds will definitely have Chinese tech. So when you've got KWEB and Yin already getting money flows in China with interest rate cuts and stimulus, you'll definitely get a lot of buyers on JD. So this one is more of a very safe blue chip hit for those who want some buying opportunities within China. JD Retail. I would love you to listen to this. On track to emerge from record sales funk, JD Retail CEO. How about we listen to this video playback? Let me see. Let's go listen here.
Technology, computers, and coding are
in the first quarter, there was a sizable increase in service revenues for JD.com Retail, providing services to third-party sellers on the platform. Do you expect that to continue in the second quarter and into the rest of the year?
I think our service revenue will grow relatively steadily in the second and third quarters. It's still hard to say how much it will grow, but it is part of the overall ecosystem for marketplace merchants. So long as we do a good job in the infrastructure of the ecosystem, the growth will remain healthy.
In the first quarter, JD.com Retail reported a slight drop in revenue, but an increase in operating income. Why was that?
投资人当时也问过我们。
There are
应该是
many reasons. One of the main reasons is that JD.com has provided the largest and most complete supply chain in China during the 3 years of the pandemic. In the past 3 years, JD.com has won the trust of many users and has taken on the responsibility for delivery at many epicenters. Therefore, when the pandemic ended, our first quarter growth rate was slightly lower compared with our previous high base. For some other companies, they had a rather low base during the pandemic. There's a trade-off in the middle, but we did realize the changes in consumers since the second half of last year, so we've been constantly adjusting. I believe you'll see an upward curve in the growth rate when we release results for the second quarter.
So you're expecting revenue to start to increase again in the second quarter?
We will definitely get better and better.
What does that tell you about the rest of the year and what to expect in terms of the marketplace for the rest of this year?
从我们自己
Judging from our own business situation, JD.com is constantly gaining consumer recognition, so we're relatively optimistic and confident in the second half of the year overall.
Right now, for JD.com, what would you say is of greater importance, market share or profitability?
长期来看呢，我觉得市场份额是每一个
In
企
the
业
long run, I think market share is necessary for the survival of every enterprise. When you don't have market share, the profits are actually fake. So I don't think this is what an aggressive company like JD should do, caring only about profit. We've always believed that profit should be a natural outcome, but a warning indicator in operation. We couldn't take on measures that turn out to be too aggressive and lead to a big decline in profits. But as long as the measures to expand our market share are reasonable, we should take them to serve more consumers and gain recognition. So we make long-term market share a priority.
What are you thinking about overseas going forward?
我们在海外有非常清晰
We have a very clear strategy overseas. JD.com has advantages in supply chain and logistics. Of course, it may take some time because of the overseas market. I believe that we can see more and better progress overseas in the second half of this year and next year.
更多和更好的进展。我们海外有单独的团队。
Yeah, so actually, guys, I am quite bullish when it comes to obviously China. I do have a lot of reasons why, not just about China's rate cuts, but one thing that is really a standout for China is that you are coming from a very low base. Aside from the fact that you actually have very low valuations here, some trading at about as low as 2014 levels, whether it be JD and Baba that you're looking at. I didn't actually anymore right here Baba, but definitely I am a believer that JD and Baba are good long-term plays here for you to buy in an elevated market in the US. JD and Baba continues to actually display clear strategies for spin-offs for Baba. JD Retail is actually profitable with market shares increasing. And definitely the second half 2023 for China is quite optimistic. In fact, I'm thinking that Hang Seng Index, which just traded at 20,000 again, is actually going to be back not just at 24 or 25, but definitely if you have the time frame to wait it out, a lot of things can change within the next 12 months. So this is actually something that you may want to actually be looking at, because definitely while everyone is obsessing about how expensive the US tech is, there's actually a lot of valuations other than US that you should look at, especially international, such as China. So there's really quite a lot of things to unpack here, but I do want you to actually be I want to basically end the session here to tell you that Yes, the market in the US, people are discussing about the bubbles that they're seeing on the likes of semiconductor stocks like Nvidia, but it shouldn't actually deter you to assume that everything in the market is actually expensive. In fact, as everyone did say, the breadth of the US sector has been slowly or gradually improving, wherein the strength of the US tech is actually now spilling over to other parts in the region. Sometimes in the small caps like the Russell 2000, sometimes in the international companies like China. I would say that recently we've seen some breakouts in Polish game company CD Projekt Red, as more and more people are recognizing, hey, the game releases and expansion updates are getting better and better sales. Of course, we've seen Nintendo do well. We've seen the IPO market now throwing with Mediterranean chain Cava last night, getting a 99% increase from debut. That tells you that the sentiment or risk appetite is there for the market to get attracted for, even if it's not necessarily an AI name. You've got actually a lot of companies recently rising that are not AI names. Of course, I said the home builders are actually beating estimates. There are, of course, the traditional companies that are also doing well due to AI. So generative AI plays happened for your Adobe. Adobe was rising from $350 to $510, which is about up 30. How much is that? Nearing 50% essentially in just a month. So, of course, you've got really stellar movements in the AI place. I'm not discounting that. But it's also true that you are seeing a more diversified way or a more rotationary play, I would say, this month of June. So I've been seeing a lot of movements in the small caps, a lot of movements in the international zones, such as Chinese companies, and then even the parts where you assume negative news, and yet the market is already pricing in a lot of negative news and actually buying amidst that bad news. So I would say that the retail sector, you want to be watching whether that is short covering or a sustainable recovery, with the assumption that high interest rates with the and inflationary peaks with inflation peaking, that maybe we do get a soft landing. Maybe interest rate cuts are in the horizon, not this year, but maybe next year. Whether it happens next year or not, we'll see how the retail or the consumers will actually spend over the next 6 months. So that would actually be a bumpy road ahead. I wouldn't call it like a considerably strong move, but it's something for us to be watching. No, so there's definitely quite a lot of movement, I would say, happening in the markets. So watch where people are spending their money, because if you can prove that over the next how many 12 months or so that people continue to spend and execute very well on companies like JD or Alibaba or the Nikes or the Targets, if people consider cheap bargains going into the likes of Dollar General, and they continue to shop there, then there's definitely some leeway for some revaluation and re-rating. The same way that Domino's Pizza can actually recover from the likes of $300 or even Home Depot. So there's definitely a lot of things to consider. And I didn't actually mention here in to the extent that look as well on Disney, look as well on Starbucks. There's definitely a lot of those household brands that have existed for over 50 years or more that are actually trading at not excessive levels at all. So I would say that for people who say everything is expensive in US, that's not true. It is expensive in a few sectors, and not all sectors are actually expensive. Now, some would say, well, retail is cheap for a reason. Maybe yes, that's why I presented all the bad news as well. But you might want to actually take a look at the fact that, hey, maybe that bad news is also priced in. So watch out for potential earnings surprises as well from the American consumers sometime in the next 3 months, 6 months, or even 12 months. So that's it. And thank you very much for watching the show. And I hope to see you again next week. This is Nikki signing out.